Well, good afternoon, everybody. Welcome to our quarterly conversations with Rick Bell and Dan Brady. This program is set up to help our clients, our partners, and our friends understand our thinking as we peruse through various different articles and headlines throughout the quarter. Dan will methodically lead us through the quarterly letter that he authors, and together we'll share our experiences, our knowledge, and ideas that we come up with throughout the time frame. One thing that I found very interesting that our audience didn't see, Dan, was the first picture that that Erica had put up. Erica's our marketing consultant, and she put up that first picture on the quarterly conversations or on the newsletter that you created of somebody floating down in an umbrella, and her goal was actually to show a soft landing. And I responded back to her. I said, do we have to use that picture? Can we find something that's a little more confusing? And she comes up with Wall Street. So I thought that was a pretty good follow-up picture to be a little bit more confusing to the show a little bit more confusion, because that's what we're dealing with right now. There's a lot of confusion in the market.
Well, yeah, I think to add to that confusion was the interpretation of soft landing, and we'll talk a little bit about that, but we'll see. We're seeing headlines and hearing that terminology a bit more in the news, but it's certainly as far as I'm concerned, and I think Rick, you're in the same boat as me. That a soft landing rarely, if ever, happens when you're at the end of a cycle like this. In fact, I saw I didn't put it in the presentation, but I did see like one of those political cartoons where it was a blimp like the Hindenburg, and it said the Federal Reserve, and Jay Powell's in the cockpit, and it's crashing and it's burning, and he said, I said a soft landing. I didn't say anything about fiery landing. So I didn't add it, but anyway. So yeah, it is certainly confusing. Hold on, my mouse isn't working here. There we go. Yeah, it is certainly confusing. And I think there are a lot of threads to follow right now in the market. A lot of different themes that we're going to try to parse out here a little bit into what are the distractions? What are the things that are actually driving the economy and the market right now? What are the things that we need to be listening to? What do we expect next? But it's very difficult to know which thread to follow here. We were talking right before this about Jerome Powell today had a forum at I believe it was the Economic Club of New York, where he was interviewed or gave a speech. And he says, well, the economy is strong, the economy is very resilient, which is true. The market this year, the S&P 500 is up about 15%, although last September, in September, it actually fell by over 4%. So actually some of the upside has some of the air has come out of the balloon, so to speak. But there are a lot of different things happening right now. And ultimately, I thought this quote was poignant. I've used different variations of it in the past, but this was something that came out back in the 80s, which is to say that 9 out of the last 5 recessions have been predicted by the stock market or economists, which is to say it's very hard to predict a recession. It's very hard to predict what happens next. And a lot of times you'll get false signals and it's kind of a coin flip. So we're going to try to, create some clarity around where we see things going.
And I think the idea in predictability is in an environment like this, it's very hard to predict. Just follow the Fed and follow what the Fed says, and typically the Fed's going to do what they say, and that predictability will follow with the market. I think when we get into a normalized market, the predictability comes back. But right now, it's almost impossible.
So, some smaller factors, which a lot of times end up becoming the things that we talk to clients about and end up becoming the things that make investors nervous, are those that are kind of grabbing the headlines, right? So and nowadays there's information coming at you from every angle, and we hear about things like the United Auto Workers strike, costing, this was just an estimate, but costing about $1.5 billion a week, initially across 3 states. It's now escalated to 20 states, in 38 different plants. So the longer that goes on, that's a drag on the economy, drag on production, limited. Obviously, with the workers striking, you're going to have demand issues, or supply chain issues. Obviously, if as we remember from, excuse me,
God bless you.
As we remember recently from the pandemic, supply chain issues, do tend to have upward pressure on inflation. And at the same time, we have things like student loan payments and all the other pandemic relief benefits sunsetting, which can create that same effect of, sort of that excess liquidity sort of evaporating from the economy, which may be good news for inflation purposes. So you kind of have a little bit of tugging in multiple directions. But of course, if the Fed is overcorrected, when inflation does start to pull back, that can be a detriment to economic growth. Interesting thing with student loan payments that I don't think is talked about enough, even though they are resuming this month, and I think it was about $70 billion each year that it's going to cost American households in aggregate. One thing that isn't really talked about is that the borrowers with large balances, most of them are on income-based repayment, and they haven't had to recertify their income since 2019. They're not going to have to recertify again until mid-2024 using this year's income. So actually, a lot of the pain from the additional drag of sucking the liquidity out from student loan payments probably won't be felt till mid-year 2024, even though they're resuming right now. So it's kind of like a 1-2 punch, where you're going to get payments resuming now, and then a lot of borrowers needing to recertify income next year in July, and a lot of folks are going to get a big step up in what those monthly payments are going to look like again next year.
Yeah, I think as an example, we had talked to a couple of clients that have those payments, and I think from what I can recall from some of those meetings, I think those payments can go up as high as 10 times.
Sure.
Starting out with $300-400 a month in payments, going up to $4,000 a month in payments next year.
Yeah, and it depends on your earnings. It depends on your balance. But the point is it's basically like the last 3 years never happened in terms of your earnings. And if you have student loans, and especially if you're earlier in your career and your earnings are growing, you're gonna you got to get ahead of it, because that will happen. But it's again in aggregate going to be a drag on the economy. We all know mortgage rates are spiking.
We hit today. We just read today that they're up just over 8% today, which is starting to put a little bit of a drag on home purchases.
Yeah. And interestingly, real estate values seem to be holding up, but the froth has come out of the market for sure. Right. And lastly, the Israel conflict and how long that's going to drag out, what that's going to entail, and again, these are all individually fairly small. You could argue in aggregate this is a lot, but basically the point here is that these are all smaller factors as it relates to the larger picture of where are we in the cycle, what's happening with the economy, what could send the market into a tailspin, and what happens next. And I think, to be perfectly honest, with most of these, again, these are kind of the headline getters that you read about and kind of create the anxiety, but ultimately aren't what's driving the market right now.
It creates the news. Creates the news. Student loan payments are coming back on in September, and that could put a drag on the economy. Oil prices are up to over $92. That could put a drag. I find that fascinating that the news people consistently push for that stuff. What they don't say on the other side is like the mortgage rates being at 8%, and it's slowing down home buying, but they don't talk about the inventory being super tight. They don't talk about home building, new homes being built is nothing even close to where we were in 2005 and 2006, substantially less. So they don't talk about that, and that, just because interest rates are going up doesn't mean it's gonna slow things down that much. And then it's interesting, the Israel and Hamas conflict, that in itself won't put too much of a drag on the economy, where what's going on over in Russia and the invasion of, and I can never remember the name of the country. It's mentioned 15,000 times a day.
Ukraine?
Ukraine, thank you. And the war that's going on over in Ukraine and Russia, that could put a supply chain issue. That could create a supply chain issue in that respect. If China goes after and attacks Taiwan, that could create a supply chain issue. And a lot of those supply chain issues have happened in the early 70s, the late 70s, as interest rates were going up at that point in time. And that caused interest rates and inflation to go up higher. But the Israeli and Hamas conflict does not have that level of impact, I believe. Except just on oil. I mean, they're talking about oil prices going up because of that. I don't think it's going to have that much of an impact. So, as you said, Dan, I think the news, the press releases that come out with this, and all the hype that's created around it isn't going to have that much of an effect on the economy overall.
Right. Yeah, and we can come back to this because I do think there is something to be said for how could it affect the economy, but oops, skipped the slide there. So here are the bigger factors, and it's really a lot easier to sum these things up. It's jobs, it's inflation, and it's the Fed. So I what's happening right now is we have, and this is a projection, because the Fed uses sort of a real-time gauge. But third quarter readings for economic growth, GDP growth, are showing almost a 5% annualized growth in GDP. Now, that's great news. However, the issue is that inflation is currently in the 3 to 4% range, and the Fed's target is 2%. So we've went through an aggressive cycle of interest rate hikes. The most aggressive in the last several decades, and yet inflation has still not come back down to what the target rate is. Now you might say, well, what's 3 to 4%, 2%, we're close enough, right? And of course, there's always the opportunity that the Fed could move the goalposts. But I would note that even a 4% inflation is twice their target. It's highly unlikely that they're going to live with that for an extended period of time. And if it does persist, there's going to be, potentially severe implications that the market is not expecting if inflation does in fact persist. And of course, some of those small factors we talked about on the other page can contribute to that. But probably the biggest one that contributes to inflation is the labor market.
Yeah.
Right. So now it is cooling. It's not back to quite to normal yet, but the August jobs reports, where we're adding about 150,000 jobs per month. Q1 we were close to double that, right? So the market is certainly cooling to where it was at the height of the wage growth being at 6-7%. And I think you had some unemployment numbers you were sharing with me before.
Yeah, the jobless claims just came out today, and the jobless claims are the amount of people filing for unemployment. And they fell to a 9-month low today. So ultimately, this is a sign of strong growth, and the strong growth continues to persist, because if less people are filing for unemployment, it means there's more jobs out there.
Right.
And I think the interesting thing in this process too, what is not mentioned a lot out there is, I read a book back in the late 90s called the Great Retirement Boom, and which actually started in 2007 and is supposed to go. It's the baby boom generation that starts retiring at age 65 in 2007 and goes all the way to 2031. So we're not done there yet. So I believe this job issue can continue. When we hit that 2007, there was a lot of people that were going to retire, and even that we had getting ready to retire decided to push it for another couple of years into 2010, 2012, which I believe everybody did. And then when COVID hit, they decided to back it down and pull out of the market. And now we're starting to really see that aggressively, and with the labor market as it is. So I think that can continue continue through this decade at least.
Yeah. Yeah. And obviously why that's important is if you have a strong labor market, that's going to contribute to inflation.
Right.
And
the Fed,
at this point, with the Fed's posturing is essentially, they kind of have gotten to this point where they're not really hawkish. They're not really dovish. They're kind of like sitting on a fence, but the expectation right now is one more rate hike this year at the November meeting. So another 25 basis point rate hike in 2024. And then the expectation is that they will hold steady
December
and consider cuts not until mid to late 2024 is the current expectation of what the path of interest rates is going to look like. Now, we don't know, how much they're going to cut or how long that's going to be drug out over. We just had an aggressive rate hike cycle. Right. But the expectation is that they are going to hold them steady. So, I've been telling folks that are, considering a real estate transaction, if they're looking to get a mortgage, it's don't expect those rates to drop down for at least another year, if not more. And to a point where it's worthwhile, if you're getting 1% or more of a swing in the 30-year, you might be waiting 2 years for that. You might be waiting, depending on how jobs and inflation goes, could be waiting longer, but it should come back down. We should be reaching the end of this rate hike cycle, but we're going to remain elevated for a little bit here.
Yeah. And I think you got some slides coming up too that it will show that short term. Once that short term drops, it doesn't necessarily mean that the long term rates will drop. It's just a steepening of the yield curve. So ultimately, although we are at an 8% mortgage rate right now, it's going to, and it most likely will drop from there. But I doubt highly that it's going to drop below 6%.
Right. Yeah, we're certainly not going back to the 2-3% we saw. So I mentioned interest rate policy, and obviously that has a lot to do with this soft landing chatter, and geopolitical factors, obviously have a lot to do with this too, because when you're at this stage of the cycle, things like supply chain disruptions due to wars, or just, it doesn't even have to be a war. It could just be reshaping of global demand and how we conduct trade with our trade partners. We are in a more precarious situation where engineering a soft landing kind of requires a lot of coordination between things that are, to be perfectly honest, out of the Fed's control. Things that literally that you just can't, you can't control whether or not these events impact the market. And what I would say is that the way we're kind of looking at this is these things run in cycles. So there's economic cycles and there's business cycles, right? Which are your typical, you have your expansionary period, you reach a peak, you have a contractionary period, you reach a trough, and then it kind of, repeat, right? Similar thing for both economic and business, but it's kind of like when we say the economy is not the stock market, right? You could be at different phases in the economic cycle and the business cycle. You could have a pullback in the business cycle without experiencing a broad recession. But it's important to note that from an economic cycle perspective, we've been in the late innings of an expansion for quite some time.
A long time, yeah.
And we've had these interventions of liquidity due to things like shocks like COVID that sort of delayed what was an inevitable recession. But the point is when you get to the end of these cycles, it's inevitable that there's contraction. Sort of the inverse of that is the interest rate cycle, right? When you get to the end of these hike cycles, like we are right now, the inevitable outcome on the other side is rates will come back down. Now, again, just like we say with recession, the question is always when and by how much, which that's where the crystal ball, gets a little foggy. But we know that rates will have to come back down at some point. Obviously, when is yet to be seen, but those cycles are tried and true, and that's how it always happens. So having said that, and talking about the rates, Rick, you mentioned it, and again, this is starting to has been getting some more and more press in the headlines. So I wanted to put a piece in the commentary about this because I do think that it's important to understand what we call the inverted yield curve. And essentially what that is, inverted means the yield that you get on a 2-year treasury is high. This is the classic example, but just think of it as short-term, long-term. The yield you get on a 2-year treasury is higher than the yield you get on a 10-year treasury, right? That's an inverted yield curve. And what we're looking at on the right-hand side, the chart shows the spread, meaning take the 10-year minus the 2-year. How much more is it? 1% higher? Is it 2% higher? Is it, what is it? If this line here is below 0, that means it's inverted. That means it's lower. And what you'll notice,
when are you writing on the screen? Because I can't see you when you say this.
I'm not right now. I'm just kind of describing it.
Okay.
But what you'll notice here, I can point to it. What you'll notice is every time that this inverts, okay, what's soon to follow is this shaded area, which is recession, right? So there's a recessionary period after the yield curve inverts. So it's, kind of been dubbed like this is the most reliable recession indicator. And it kind of makes sense, right? Because this means that the cost of capital is sort of turned upside down. Like this just doesn't make any sense in the markets at the end of an expansion cycle when this happens. The interesting thing is that we don't really have any good, clear indicator of, so how long from when the yield curve inverts, like when does the recession happen? We see in multiple scenarios here where it crosses over 0, comes back, crosses over again, crosses over and a recession is immediate, takes some time. What typically ends up happening is once the trend starts to reverse, meaning once you start to see that come back to normal, And oftentimes, once it actually does get back to normal, back here, in fact, this was Paul Volcker screwing with interest rate policy back here in hyperinflation. But every time that it starts to increase back to normal, that's when you can sort of say, okay, a recession is very close. And the reason is, again, kind of makes sense. The market is now pricing in, financial markets are now pricing in what the new cost of capital is going to be for the next cycle. And think about all those investments and all those bets that were made during the current cycle. They start to look obsolete, and that throws you into a contractionary period, because now that capital markets have priced in a new cost of capital, and in our case, a much higher cost of capital than what it was over the last 10 to 15 years, markets sort of reset, go into a contractionary period. And that's when you have, coming out of those increases, you have recessions, right? So we would expect, and again, it's a imperfect indicator as the timing, but typically once you start to see that increasing and start to seeing it normalize, that's when the recession is imminent, rather than an uncertain future outcome.
Yeah, and Dan, I got actually, I got a couple examples of this. If you want to give me some control, so it's on Arturo Estrella and Frederick Mishkin. Actually put out an article on the prediction of utilizing the yield curve to predict what's going to predict the next recession. And actually, let me just get my drawing. If I can figure out how to draw with this thing. So basically, this is our percentage probability of recession here. Okay, so if now this instead of using the 2-year, Dan, it uses the 3-month bill, and that
Right.
3-month bill, if the 10-year drops by let's say 50 basis points below the 3-month bill, that indicates a 40% chance that there's going to be a recession in the next 4 quarters. Now they do indicate in the article as well that it goes from I think 2 quarters all the way out to 6 quarters. So it could have a little bit more of a delay that we might see here. But I think at one point, we got close to 60 to 65% predictability that there's going to be a recession in the next year. So what I also want to show you here is this is the 10-year and the 3-month Treasury bill, and this has indicated here that, if everybody can see that, we actually September 2023 we hit 1.8%, which put us at about close to 60% that we were going to have a recession in the next 12 months. So that actually puts us out to here, actually 56%, as it indicates right here. 56% chance.
By September of next year, the model is basically saying by September, so within the next year, the recession, I believe will have started. Is that right, Rick?
Will have started, correct? Yeah, and this is where the interest rates peaked up to that percentage number. So it's of 56% here. So, but yeah, that's the fact that it would have started, correct, Dan?
Yeah.
Which I find, I've been following the yield curve 25, 30 years, and I've been tracking it. Every time that there's a recession, I watch it, and you can bring your page back up. And typically, they were talking about the 2-year and the 10-year, that we crossed over that last June, and indicating that there's a recession coming. And it's really the predictability gets much greater as that. Oh, that's the other thing I wanted to show you too. One other thing. Let me have this back. I'll show you a normal yield curve. Back into here. I got another This here is a normal yield curve. This goes from 3 months all the way up to 30 years. And this is typically what a normal yield curve looks like. This is actually back in October 2004. And this is basically what our yield curve looks like now. And this is kind of what we were talking about earlier, where the yield curve is substantially inverted in this direction.
Right.
So, but I watch that all the time. I check the yield curve constantly, and as far as I'm concerned, it as it steepens, as it inverts aggressively, that's when it becomes a higher probability that there is going to be a recession. The question is it going to be in 2 months, or is it going to be in 2 quarters, or is it going to be in 6 quarters?
Yeah, and that's what we don't know, obviously. I think that we're starting to see, and we obviously, it's been inverted, by the way, just for everyone's information, it's been inverted for quite some time.
Yeah, June of 2022.
Yeah, so and this is why we're starting to really pay more, and this and which is also one of the reasons why we've been very defensive. Even though the market seems to inexplicably be doing quite well, we've been very defensive because we this is typically a bearish indicator. But this seems to be coming to a head because if you think about that chart that Rick just pulled up, to get back to the normal where it goes, lower on the left, higher on the right, rather than the inverse, one of two things would either have to happen. Either those short-term interest rates would have to, decrease. So for example, right now you can walk into a bank and get a 1-year CD for 5%. You could also go to the US Treasury website, and get a 10-year Treasury for like I think it's like 4.8%, right? Something like that. Doesn't make much sense. Why would you be compensated less for locking your money up longer? So anyway, that can either be perpetuated by that short-term, 1-year bank CD. If all of a sudden that dropped through the floor and it was giving you 2%, okay, great. That's more normal. The other thing that could happen is maybe that bank CD stays similar and the longer term rate increases, right? So now all of a sudden that bank is paying you 5% for your 1-year CD, but you could go to the US Treasury and buy a 10-year for 6 or 7%. Not saying I think we're going there, but you get the picture. The point that I'm trying to make is that recessions tend to be led by an increase in the long-term rate before you see the short-term rates drop.
Yeah.
And what we've been seeing, and the chart that on the right shows these purple bands, which is showing increases in the long-term rates, which are perpetuating that return to normal. And that has recently, within the past month or two, started happening, that you're seeing those intermediate and longer term rates starting to match those short-term rates. And that's what they call a bear steepening. If you think about it this way, what's happening is the bond market is starting to price in the new cost of capital for a longer term. So, if you think back 3, 4, 5 years ago plus, your mortgages were at 2 to 3%. Your treasuries were paying 2%. Your bank accounts were paying nothing, right? And now all of a sudden with this aggressive rate hike cycle, oh, great, savings accounts are actually paying interest again. I can get a CD. This is all well and good, but the longer term aspects haven't caught up with that, and they're starting to. And that means that now those financial markets are starting to price in. We believe that this is a new regime. And that typically means that you're right at about that inflection point where a contraction is about to happen, because that cost of capital has not been fully digested yet by all market participants, and eventually that pill will need to be swallowed, so valuations will come back.
Yeah, and the bear steepening, as Dan explained, is the longer term coming up to meet the shorter term, more of a flattening of the yield curve.
Flattening
The
out.
bull,
Yep.
right?
Yep.
The bull steepening is more or less that short-term rate starting to move down fairly aggressively. So,
Right.
and that the bull steepening actually was an indicator that the market is going to move pretty aggressively. That we have good economy coming up. We have a stock market that predicts that good economy coming up. So it's opportunity to then to move more into the equity
I'll
markets.
play that out for a second, right? Let's say we're right. I'm not saying that the sky's falling, but let's say we go into a recession. Think about what happens next, right? What happens if we go into a recession? Let me go back here. The Fed is going to decrease rates, right? Because they're going to want to stifle growth again. So when they decrease rates, the first thing, the most sensitive thing is short-term rates will drop down. And that's bullish because now your cost of capital is starting to get lower. Right. So the bull steepening says, hey, we flattened out. These long-term rates went up. It threw us into a recession. Now the Fed is starting to decrease interest rates. So this is going down. That's a lot more bullish because now, again, when rates decrease, the entire point is to stifle growth. So when you start to see that happening, that's when you can tell that the wheels are being greased, so to speak. And that's when it's time to become optimistic about growth. But for now, as those longer term rates are going up, that cost of capital is going to have to be digested by the market, and it just hasn't happened yet, and it's likely to be digested by the market with a contractionary period. Which to your point, Rick, is more than a coin flip likely will happen sometime within the next 2 to 6 quarters, pending another historic intervention by the Fed, which they are always one to do. So,
or a supply shock, Taiwan getting invaded by China, Russia moving into Ukraine a little bit more aggressively. All those things could be a tragic situation that kind of pushes this in a different direction.
Yeah, and I think that's a good segue because just talking about outlook, it's funny because there's always a lot of soft landing chatter in these types of scenarios where it's, well, the economy's strong. We think that we can actually engineer a soft landing because, of course, the economy's always strong when you're at the peak. That's kind of the definition, right? Like you're at the peak. You made it to the mountaintop. Like everything looks great. Right. So soft landing chatter is nothing new when you're at this stage of the market cycle. One of the things that makes me, and this has actually been the case for the last 2 years since the yield curve's been inverted, earnings guidance is like through the roof. Like forecasts are saying 12+% on average on S&P 500 companies. So, we've talked about this before, but in investing in the stock market, it's not always about good or bad. It's about better or worse. So, if earnings are up 8%, that's worse. So that's quite a line in the sand to draw for forecasts that, as markets are trying to digest this higher cost of capital, I'm skeptical that earnings are going to meet or beat expectations. So I just don't see a lot of tailwinds there. In fact, it seems like a pretty tall order. Sure, perhaps they're going to meet estimates in a given quarter, but I don't see that being a pervasive trend that earning forecasts are going to get will be met or exceeded when they're in these double-digit figures. I also think that, again, talking back to the Jerome Powell speech earlier today, I don't also necessarily think that just because we have a strong economy means that we should, as investors, think, well, that means we have a strong outlook for the market. I think there's maybe some mixed signals there. And to your point, Rick, with those sort of, whether it's, Russia invading Ukraine or China invading Taiwan or
a black swan of some sort that we don't anticipate to happen, which usually does.
Right. And the point there is we don't know, whenever the next recession does hit, we don't know what it's going to say in the history books as to what caused it. But most of the times recessions are actually caused by some unseen risk. Like nobody predicted the pandemic, or, who thought that the mortgage market would crumble. Who thought that there would be a tech bubble, or, Black Monday, a stock market sell off, and all of these things are unpredictable, unseen risks. But the point is, the preconditions that led up to them being able to topple the market were all very similar to the preconditions that exist today. So, it's kind of like a domino effect, or the analogy that I liked from a segment we watched recently was, it's kind of like thinking about if you're riding a bike on a flat road versus if you're pedaling uphill and you're slowing down. If you're slowing down, you can only get to a certain speed before a slight breeze will just knock you over, right? So that slight breeze, it depends on the conditions under which you are pedaling. And ultimately, the conditions that we see now, some external shock would have a much greater probability, that unseen risk would have a much greater probability of causing a recession than, say, if we were in the expansion from, 2013 on, where we saw low cost of capital and a strong market. A slight breeze isn't going to knock you over there. It's basically like you're pedaling on a flat road. So I think that the thing to think about right now is a couple of pieces. Very important to stick with the strategy and not to chase returns, because we're seeing this like inexplicable run up in the market. And our thought process right now is that this does tend to happen late in the cycle, is there tends to be kind of like this over exuberance, over optimism. We want to stick with the strategy of being mostly defensive, but we also want to be aware that that doesn't necessarily mean that just because you can get 5% on a 1-year treasury, that you should sock everything into that 5% guarantee, because of two things. One, cash doesn't rally. And two, most of those good return days that gives you most of your return, we've done we've cited this in the past, where if you miss the 10 best days of the market over a decade-long period, your returns in the market are halved. But most of those big days happen towards the bottom when it's coming back. So you don't want to try to time when's that bottom going to happen and say, I'm okay with just getting 5%, because you're handicapping what you should be getting in the risk part of the portfolio.
Yeah, and I think your key down here on the do side, Dan, is patience in this market, because as we were talking earlier, this the flattening of the yield curve can remain for a little while, and clients tend to be a little impatient. People tend to be a little impatient and trying to grab returns, and all you're seeing is that 5% on money market, which is great right now. But your stock market side it tends to be slightly above, flat, or in some cases down, and that keeps the portfolio squeezed to a lower end, and we're all trying to grab higher and higher rates and higher returns in a market that right now is not willing to give. And we talked about in the past too, the indexing is going to be harder and harder, because it's going to be the fewer investments, the right picks. Technically, as we've seen in the S&P lately, there was roughly five of the what they call them, the fabulous five, that were giving us the returns over the last 12 months, or over the last actually 7 months, 10 months, 10 months, and which was totally unexpected in this environment. So once we see that and we're not in the market, we decide, if we decide we want to go after that, all of a sudden the market drops off again. This market, as you talked earlier, is very unpredictable. So being patient in this market is probably your biggest key factor with this process.
Now, I talked about the cash trap. I do like, however, and we've talked about this a lot, for bond positions, fixed income positions, we do like the idea of, the sort of non-risk part. Yeah, sure. Lock in that 5.5% because that's your ballast when and if the recession does happen. I shouldn't say if, it's just when and by how much. But that's the ballast because there is no guarantee with what's going to happen, even though bond markets tend to be more more protective. After a 2022 where we saw the Barclays Agg down 13% when an unprecedented move, seeing that guaranteed 5.5% for a conservative ballast is certainly attractive. We just don't want to, quote, go to cash. Right. Because that's when you make the timing issues and that's when you make the mistakes.
Yeah. Stick with a strategy.
We also don't want to say, hey, these conservative stocks or this diversified portfolio is underperforming the market and I'm missing out on that. Let's get in because that is not something you want to be doing right now.
Yeah,
that is not.
Yeah. And that, as you can see that in the growth in the value environment right now. So the growth is actually providing the good quality growth is actually providing less volatility right now, a little bit more growth, where the value is kind of backing off at this point in time. Where the value comes into play is when you run into that recessionary market, and the value tends to play a big role in producing returns for you.
Right.
So one thing I didn't mention in the beginning, which I went right into my presentation and didn't mention, that if there are any questions, we have a question and answer section down at the bottom of the screen there. I'll be monitoring that. If there are any questions, it seems in the past that we've tend to answer everybody's questions as we go through this, because it is a follow-up to the newsletter that Dan authors every quarter. So, but if there are questions, please put it in the question and answer section at the bottom. All right, what else you got, Dan? I got some thoughts. There it is. Go Phillies.
Go Phillies.
Yeah, how about them Phils? Let's talk about statistics. The fact that they're killing it on home runs scares me, because once those home runs stop coming, it's going to be tough. Hopefully, they don't stop coming this season.
I will give you one guess. Players who have, in the history of baseball, hit 15 home runs in their first 50 postseason games.
Say that again. One guess. The what?
The list of players who have hit 15 home runs in their first 50 postseason games.
I have no idea. I'm not that good with baseball.
Babe Ruth, Bryce Harper. That's the list.
That's the list. No kidding. Yeah, Bryce Harper's a beast, and we got him. That's fun. So yeah, so I'm looking forward to the Phillies game tonight. I just want to step back, since we have a little bit of time. Sure. What time is it? We have a couple minutes still. Talk about the housing market a little bit. Housing prices have gone up quite a bit. People that I talk to, both on the streets, clients that I talk to, individuals in various different environments that I meet with, they're questioning the housing market and believe that it can drop fairly aggressively. And I need to kind of put the brakes on that a little bit, because we're not in an environment where 2007, where we were in 2007, where there was a lot of buying in the housing market, and that buying was created through not paying attention to your credit scores, and you'll see credit scores coming up on the news a lot now. They talk about how the biggest banks have an average of 800 credit scores, and you get down into the smaller banks, and their credit scores are averaging The credit scores for their account holders are averaging in the 7 range, and below. And the fact that people can't buy houses, but we are not in that environment that we were in 2007 and 8 and 9. We are in an environment right now where is a very low inventory of housing right now, and we don't see that inventory opening up aggressively. We are not like back in 2007 and 8. It was more or less a building boom, and everybody was seeming to be a developer at that point in time. By the time you got to the end of this building boom, everybody was a developer. So we don't see that. And you don't see people owning 4, 5, 6 houses at this point in time. So you see new people coming in wanting to buy a house. And so I don't see the housing market dropping off aggressively. I do see it flattening out quite a bit, which it tends to do. You can look at short parts of the housing market and you can see increases and decreases. But at this point in time with the housing market, I don't see anything that will indicate that the housing market is going to drop off aggressively. I think we're going to flatten out on this.
Yeah, I think what you're going to see is locally, I think locally a lot of markets are going to try to grapple with what's the right price point. So a lot of the higher end stuff, the kind of the froth has come off the top, so to speak, where you were getting, all cash offers within 30 days for, $2, $3, $4 million properties. That seems to not be happening as much anymore. The reason I say I think local markets are going to try to kind of grapple with it and figure it out is that the groundswell of demand from the millennial generation is massive. And the fact that, to your point, Rick, they're just, not only is there not the inventory, but there aren't as many builders, technically means that even with rates going up, what it did was at least the thesis here is it maybe took the froth out of the top end of the market, which kind of pulled up the rest of it. But with rates going up and that groundswell of demand, there's still likely to be a lot of buying activity because ultimately, I think I read a statistic, and I'm not sure if this is still accurate, but something like half of millennials still haven't bought homes. And, the fact that inventory is so low, it's kind of like there's not much else you can do. It's like rates are what they are now. Mm-hmm. And I think depending on what those local markets end up doing with, kind of like what's a fair price for a house, you're going to see the top end of the market, sort of like the yield curve, the top end of the market's going to drop off. You're going to still get a lot of buying activity in the bottom, and then the mid-level of the market will probably level as to whatever the mid-level ends up being of a particular local market. But the fact that there's enough demand there is really what's driving it.
Yeah.
And I tend to agree that in aggregate, the market, I don't think is going to drop off. You're just going to see the higher end stuff, not have those excessive valuations anymore. Kind of like, if you think about it, it's kind of like tech companies, right? Like, why is Microsoft up 30% this year? AI, quote unquote, right? Doesn't make sense. There's not a lot of cash out there on the street, right? Cost of capital is going up tremendously. So you would think the froth is going to come out there, kind of like the top end of the housing market.
Yeah. Yeah. And you talk about the generation, the millennial generation versus the baby boom generation. Baby boom generation being the biggest in history. Millennial generation is 1.2 times larger than the baby boom generation. So when you say half the generation hasn't purchased houses yet, that's a sizable amount. And and people are living longer too. So I think that this could continue.
People are living longer, and don't forget most of the purchases that happened over the last 10 years, that inventory is permanently removed because nobody's getting rid of a 2.5% mortgage.
Not easily. Easily. I'm not getting rid of mine.
Right. Well, yeah. And I mean, it's going to influence selling decisions where, you're going to have folks just permanently sitting there.
Yeah. And people trying to rent out the houses as well too. So, which we've already been through a couple of conversations about that because, hey, I got a 2.5% mortgage. I can actually rent the house out. Some of the questions about that too is it's interesting because the value of the house is so high. You got to look at it and you go, well, does it make sense to put that much to leave that much money on the table to rent it out? And are you actually getting your return out of that as a rental?
Right. Yeah.
So,
yeah. Yeah. It depends on that.
But with interest rates come from 2.5% up to 8% now. The interest rates will slow the market down a bit, but I don't think we're going to be more of a normalized interest rate back to about 6%, between 5 and 6%, I believe, as this whole thing normalizes.
Yeah, no, I would agree with that. It's just question is how long does that take? And how bad is the recession that it takes to get back there? I don't think it means we have to have a terrible recession, but again, it depends what that shock is that creates it, which obviously nobody can predict.
Correct. So we're coming to the end of the hour, Dan. I appreciate the dedication and the time that you put into the newsletter and the time you put into creating this program. I know I have a lot of fun going back and forth with you on it. And I just want to remind everybody, go Phillies.
Yeah, go Phillies. This game starts in 10 minutes. Time to sign off.
All right. Thanks. Have a wonderful quarter, everybody. If there's any questions and anything that we spoke about, please call us. Don't hesitate to pick up the phone and give us a call, and we'll talk further about it. Thanks and have a great day.
Have a great day. Bye-bye.